All right, good evening, everyone. Apologies for the late start of this particular class. Okay. Um, yeah, but we'll go in now. This is going to be the first part of this class. By the next class, we'll be delving much deeper into this concept. We'll just introduce the class today, and then by next week, which is the next class, by the next class, we'll be delving much deeper into this subject. All right. Okay. So today we're talking about market manipulation. All right. So most of the time, traders believe that lots of traders believe that their trade is being manipulated, right? And by somebody to make them lose money, right? Now, in the sense that when you are trading and you place a buy or sell trade, or you understand how to analyze the market, once price is making its moves, your trades are not being manipulated. Your trades are not being manipulated, but there is manipulation in the market. Let me put it that way. So many traders have had this mindset that their trades are being manipulated. Your trade itself is not being manipulated, but there's manipulation in the market, and there are ways where it happens. There are ways that it happens. And there are places to expect manipulation in the market. So it's not everywhere. You don't just make a buy trade. An example is this. Recently, I was talking with a particular client, a particular person who felt his trades were being manipulated. Okay. But why did he feel his trade was being manipulated? He was trading gold, and then he will place a gold trade expecting gold to sell, for example, or expecting gold to buy. So what happens is that his trade, he will be watching the charts from probably maybe the 5 minutes time frame or so. Usually he's on the 5 minutes or 15 minutes time frame, lower time frame basically. And then he's looking at the market and price is pushing up. Let's say he's expecting price to buy. Price pushes up, comes down, pushes up, comes down. Like, you know, that consolidation that price can do anywhere on the chart. The market doesn't have to tell you that it's about to consolidate. You see consolidation happening anywhere. Okay. There are times where price hits a certain level and there is not enough volume to drive it at that time. It gets into a consolidation until volume comes in to drive it in one direction or the other, right? So he sees this consolidation and then he records a video and he says, the market is my trade is being manipulated. I have made a buy. Why is the market not buying? This market should be buying. It's because somebody is holding it from buying. That's why it's not buying. And then while he's watching, instead of setting his trade and say, okay, I put my stop loss, I set my take profit, I let the trade run. What he does is he sits there and he's watching the chart on the 5 minute time frame, and he thinks that because he's made a buy trade, the market should buy right now, and the market should buy significantly right now. And if the market doesn't buy significantly right now, he is being manipulated. Then after a while, he waits 10 minutes, 15 minutes, 20 minutes, and then the market is still consolidating. It goes up a bit. He thinks, oh, it's about to buy now. It comes back again. It retraces, right? And then he says, you know what? I am tired of waiting for this trade to play out. He closes it at 10 pips, and immediately he closes it. 5 minutes later, the trade breaks out and starts going. And what he was waiting for just happens right in front of his eyes. And he's angry. I waited for this trade to play out. I didn't get 20 pips. Now it has gone to do 200 pips, right? So that in his mind, his trade were being manipulated. That instrument was held down by somebody, and that's why it didn't move, right? This is not what manipulation in the market looks like. That is not manipulation, right? That is a trade playing out the way it's meant to play out. when it comes to trading, the only thing you want to understand is where am I meant to enter this trade? What is the trend of the market? What's the direction I'm expecting the market to go in? Where do I get on this trade? Period. That's what you're looking for. Once you get on the trade, the next thing is you set your parameters to stop loss, take profit, and let the market play out. The market can take 2 days to play out. The market can play out in 5 minutes and hit your target. But that is not something you can control. But when you try to control that, you'll be frustrated. Okay. So what is manipulation in markets, in Forex market? The market, Forex market is a $7 trillion a day market, right? And there is no centralized exchange where this happens, where trading happens. Okay, we said the market is a worldwide online marketplace. It's a worldwide, it's online mostly. Okay, it happens through the interbank market. And the interbank market is not an institution or a centralized exchange where it happens, right? So it happens through banks, brokers, liquidity providers. So when you're trading with Vantage, that is a broker. Vantage is a broker. But even then, Vantage has liquidity providers that we work with to bring the liquidity that you need on the system for everything to flow properly, for your trades to activate effectively, and all of that. We work with liquidity providers. We have high-level technology that helps us to put everything together, right? Manipulation happens when large players, banks, hedge funds, or brokers, sometimes governments, or sometimes what they call market makers, use the size, order flow, market influence to artificially move prices in their direction to their advantage. So what I'm saying to you guys here is that there's manipulation in the market, but manipulation is not the way many traders think it is. But manipulation happens by certain large players, mostly market makers, And then the goal for them, sometimes market makers have so much power that they are able to even manipulate the market against big time players like hedge funds. Yeah, because market makers, what are they? They are the ones that help bridge the gap between the buyers and the buy volume and sell volume. You come to the market every day and you realize that you can always place a buy trade anytime on any instrument. And there is nothing like, oh, there is nobody to fill the order. You make a buy trade and he buys. You make a sell trade and he sells instantly, no questions asked, right? Many, many years ago, it wasn't like that. If you still go to MetaTrader, the default app right now, we just download the app, not connected to any broker. You're connected to MetaQuote's data feed. Sometimes you enter a trade, you place a buy trade, and then it says requotes. You are not able to fill, your orders are not filled at the price it's meant to be filled at. That was the way real brokers was a while ago, many years ago. But today, market makers are the bridge between buyers and sellers, which means that they provide the liquidity in the market to make the flow of buy and sell happen seamlessly. So it seems like every time you make a buy, there's somebody who is picking it up from you. It seems like anytime you make a sell, there's someone anytime you make a buy, there's someone else you are buying from. You always have orders to buy. And every time you're making a sale, there's always someone to pick it up from you. Market makers make those happen. But then, just as they facilitate the market makers can also use that volume, that position, to drive price in their favor against the trader. So this is just like in any market. So it's not as if, oh, that means I have a huge disadvantage. No, not necessarily that you have a huge disadvantage. It's the fact that if you see what they are doing and know where they do what they do, you will not fall victim of what they are doing. If you see what they are doing, or you know what they are doing, you know what they are doing, you see what they are doing, you know where they are expected, where they're likely to do it, then you will be able to get out of those positions. You'll be able to set yourself up. You'll be able to set yourself apart such that these manipulations will not work on you most of the time. So that's the main thing. This has to do with liquidity. So manipulation happens because the big players who move the markets are looking for liquidity. They are looking for liquidity. So on another class, we'll be delving deep into what we call liquidity. All right. Now they are looking for liquidity. For market to move, there needs to be liquidity. For price to buy, there needs to be enough buy volume. For price to rise, there needs to be enough buy volume. For market to sell, there needs to be enough bearish volume and no sell volume. Otherwise, you will see price will be stuck. You know that price is about to buy, but it's not buying. Why is it not buying? Because there's not enough liquidity. So what happens is this. What happens is this. So when you look at this setup now, and typically what happens here is that price tends to sell from the roof there. Price tends to sell from the roof and price tends to buy from the floor. Okay? Price tends to sell from the roof and buy from the floor. But there are times where this movement here needs liquidity to happen. This price rising from here, this bullish move here from this bottom to this top needs liquidity to happen. It needs a lot of buyers and buy volume to push price from here to here. There's need for liquidity, a lot of buy volume to push price from this level to this level. So what happens many times is that you will see that price comes to this level and market doesn't have liquidity to move it. So what market makers are trying to do at that time is that they are trying to fetch enough liquidity to cause price to rise from here. Because if there's not enough liquidity, price will not rise from here. So what will happen is this. We discover, because first of all, what causes liquidity to be around this place? There are lots of trades happening. Okay, let's pick this area, for example. This move now, let's look at this. Let's look at this. Price move from this bottom to this top, from this bottom here to this top here, right? So now the thing is that price drops from here all the way to this bottom. Once it gets here, market is trying to gather enough liquidity to rise. That's why you see that during news events, price move rapidly. Why? Because money flows in a particular direction. Money is liquidity. So now the only way price will rise from here to here is if there's enough money, enough liquidity to drive price up. So what happens now is that market makers are trying to grab enough liquidity from around these areas so as to drive price up. So that is where manipulation happens. Manipulation is meant to make it look as if a certain move is about to happen, but that move is not about to happen. It is meant to deceive a certain category of players and then take away your money so that that money becomes fuel to drive price in the direction that market should be going. That's what it is. Because there's a lot of things. This when we talk about market manipulation, we cannot but also talk about liquidity. That's why I said in our next class we're going to be delving deep. This is mainly an introduction, but we're going to be delving deep into understanding market manipulation and liquidity so that we can put it together, right? So, but understand this. Understand this. When price gets to this level, it needs to buy from here and go up. But what is it? What does it need to do that? It needs fuel, and fuel is what we call liquidity. Fuel is what we call liquidity, right? That drives price, that can drive this price from the bottom to the top. Now, where is that liquidity going to come from? It's going to come from the funds of traders. If people are making buy trades here, what happens is that they put their stop loss close by below this area. Okay? Now, if these trades that are buy trades, if these trades that are buy trades now that are not causing enough liquidity in the system. Now there's buy volume, but this buy volume is not enough to drive price. Basically, what market makers are trying to do is find a way to collect enough liquidity around here from traders and investors and people who are putting monies into this level, expecting a buy, deceive them, and then cause them to and then seize and grab enough liquidity to drive price return. And usually this leads to the loss of funds for many people. This leads to loss of funds for many people, but those loss of funds for many people becomes the liquidity that drives price to the top. Okay. So I know that many of us may not get this right now, but we'll come back in the next class, right? That's why I said I wanted to introduce this class. This is I want to just introduce it shortly so that I can leave. But then in our next class, we are going to delve in, we're going to talk about market manipulation with in conjunction with liquidity as well, so that we can understand what is going on here and what manipulation is deeper, and then how liquidity plays into this, right?